Supermicro sits at the sweet spot of two things: exploding demand for AI infrastructure, and real product chops in high-density, liquid-cooled server racks. That combination is potent if the firm can convert orders into revenue without burning too much cash along the way. Smci announced and is shipping NVIDIA-powered HGX B300, Blackwell, for UNOCP liquid-cooled systems that are designed for hyperscale AI farms, systems the market needs if you want to cram more GPUs into a data center without turning it into a sauna. AB Research estimated Supermicro controlled about 9% of the dedicated AI server OEM market in 2024, not the biggest, but meaningful in a rapidly growing pie. That's a real foothold for a company many still think of as small. Why that matters: hyperscalers want validated, dense, energy-efficient racks yesterday. Supermicro has been fast to ship liquid-cooled NVIDIA racks, and when orders scale, rack economics scale fast. The numbers that keep people awake: cash flow, inventories, debt. This is the gritty part. Good products are one thing, cash and inventory timing are another. Q1 operating cash flow was deeply negative, reportable operating cash burn around $918 million, recent public filings and market summaries. That's not a rounding error. The company reported $4.2 billion in cash on hand at quarter end, but also had $4.8 billion in bank and convertible debt, which puts it in a net debt-ish posture once you think about convertibles and balance sheet reality. That math is important: cash is large, but leverage is material. Inventories ballooned as the company built to meet anticipated hyperscaler builds. Closing inventories moved sharply higher. Higher inventory plus lumpy shipments equals write-off and margin risk if deployments slip. Plain language: Smci is selling into a hyperfast market, building inventory and products to meet huge orders, but the timing of revenue recognition has been lumpy. That's why operating cash flow alternates between positive and negative. The company's cash generation depends heavily on when racks actually ship and customers accept them. Why the not capital-intensive point is important. A common investor assumption: companies making big hardware need huge capex. Not here. Supermicro's cash burn is not coming from building factories. Capex has grown much more slowly than revenue. The burn is largely working capital, inventory, receivables, and the timing of customer acceptance. That means the problem is theoretically fixable operationally: improve logistics, align shipments, rather than requiring a billion-dollar factory to correct. If operations stabilize, the business can turn cash generating quickly because the asset-light part, assembly plus systems integration, scales well on revenue. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. The product and partner advantage: NVIDIA plus liquid cooling. Two concrete competitive advantages: NVIDIA partnership and early Blackwell ship kits. Supermicro's HGX B300 systems are built to house NVIDIA's latest Blackwell B300 GPUs, and the company has messaging that systems are ready for high-volume shipment. Being first to ship validated racks for new accelerators is a real sales mode in the short run. Liquid cooling expertise. Hyperscalers increasingly demand direct liquid cooling to reduce PUE, power usage effectiveness, and increase density. Supermicro has been moving in this space ahead of several larger rivals, which gives it design win advantages and speed to market. If GPUs are rocket engines, liquid cooling is the hangar and fuel logistics that let you launch more rockets safely. Be the company that builds hangars and you'll sell more than just engines. Death cross: that's when a shorter moving average, often the 50-day, crosses below a longer one, often the 200-day. It signals that shorter-term momentum is weaker than long-term, a bearish technical setup. The 50/200 relationship is bearish and the candles show no clean-up trend. That's consistent with the death cross narrative. RSI oversold: the relative strength index dipped into oversold territory recently, which often coincides with short-term bottoms or mean reversions. Oversold conditions don't guarantee a rebound, but they raise the probability of a short-term bounce, and you've seen a green candle recently that suggests buyers are sniffing a bottom. Technical framing for traders/investors: death cross equals caution, momentum is weak, and is panicking sell. RSI oversold plus a green reversal candle equals potential tactical buy, mean reversion. Big catalysts, earnings, order confirmations, margin commentary, will trump technicals in the medium term. My personal action is buying more around $30, is a classic contrarian ad at a beaten-down level combined with fundamental conviction about product wins and market growth. Where Wall Street stands: wide range of views. Analysts are split with a wide dispersion of price targets and ratings. Some firms remain cautious and trim targets after the Q miss, lower visibility plus compressed margins. Others, Rosenblatt, Raymond James historically, emphasize AI demand and large backlogs and are more optimistic. The consensus median tends to sit in the high $40, but the spread runs from low teens to near triple digits in some optimistic scenarios. Short interest is high, roughly 17–18% of float in recent prints, which boosts volatility and the potential for both sharp declines and squeezes. Translation: there's active debate, price will swing on execution news and sentiment. The high short interest and wide analyst spread are both symptoms and causes of volatility. The bull chain versus the bear chain: what needs to happen? Bull chain: how SMCI rallies sustainably. Q2 plus shipments convert backlog to revenue, the guidance ballpark is credible. Inventory is digested, working capital normalizes, and operating cash flow flips positive. Gross margins recover as supply chain settles and mix improves, liquid-cooled racks, service. Convertibles are managed or refinanced without dilutive pain. Market re-rates the company to a more typical high-growth systems multiple. Bear chain: how things go sideways/fall, continued timing misses and persistent negative operating cash flow. Inventory write-downs and margin compression persist. Short sellers and sentiment keep pressuring the stock, multiple compresses. Financing pressure forces dilutive moves or expensive refinancing. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.